Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you've started your portfolio but need some help continuing to grow, 2022 REB Buyer's Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, Phil Tarrant, host, Smart Property Investment Show. How you going? Hope you're well. Getting stuck into property and sort of front end of this particular chat. We're recording this literally 4 days before the federal election, so I need to be sure that I don't timestamp this too much, because who knows what's going to happen come Saturday when we all go to the polls and work out what's going on and who should lead this great nation for the next 4 years. And I've been chatting about it a fair bit, and so the property commentary that I do, that whoever inherits this next term of government is going to have some interesting times ahead of them. Whether or not it's a poison chalice, I don't know. I think in hindsight, we're going to be able to fast forward 4 years and say maybe it's an election that no one really wanted to win. Rising interest rates, hiking inflation, security challenges and concerns, supply chain issues, not enough people to employ in Australia to keep driving forward. It's exacerbating across a whole bunch of different factors, which are pretty unique to this election cycle and moving on from it. Some of them will dissipate over time, and the natural forces of the economic weight of global and domestic markets will change it to the better, and borders will start opening up a lot more, and materials will start coming a lot more, and we'll start taking some of that immediate pressure on prices, which we're all experiencing right now. Whether or not the war in Europe turns into a quagmire akin to what happens with the Soviets in Afghanistan back in the 80s, I don't know, or the Americans in Vietnam. Still waiting to play that out. But you got to remember, even like timber costs, a lot of our timber comes out from out that way, and that's certainly been disrupted, hence the reason why we're getting all these different cost pressures. So the government, whoever's in government, is going to have to navigate all of that sort of stuff. They're coming out and they reckon they're going to, well, sounds like both parties want to invest somehow in Australian real estate, whether it's through super guarantees or for either how the Labor government, or super release, or how the Labor government's going to focus it. We'll get into that after the election and work out what is actually happening. But if I was going to put a catch-all for the market right now, it's very uncertain. So the question I've got is how to be certain in an uncertain market. And I just thought about that, and I thought it was pretty good, because I'm sure, like most of you, you're thinking the same way I am, as in, okay, well, I don't know what's going on, but I could certainly act on it, and how I choose to act on it is going to be determinant of how successful I am as a property investor. Joining me in the studio, Lachlan Vidler, regular guest. He's director at Atlas Property Group. This guy writes books about this stuff, and I've just learned he's actually an academic teacher, so I'm going to call him a nerd around business studies out of the University of New South Wales. Lachlan, I didn't know that. How are you going?
Phil, good afternoon.
Lecturer.
Yeah.
Lecturer as well.
Yeah, it's good fun. It's good fun. Getting into the young minds, teaching them practical real world stuff. It's good to get out of the office sometimes and do something that I enjoy doing. Yeah.
Well, that's probably similar to podcasting, right? It puts me in a different environment.
Yeah.
And I find it as a great vehicle for learning and challenging assumptions and debating things in a positive way. And they reckon the youth of today, Lachlan, one of the skills they don't have is their ability to deal with confrontation. They avoid it like the plague, whereas I think it's very healthy in a business sense to be able to have a difference of opinion and debate a particular case for getting an outcome you want. And I think a lot of them step away with it. And I'd also say, and maybe you can give me some sense for it, how good of communicators are the undergraduates of today, because I reckon the competitive advantage of the future is being able to communicate well outside of a text message or Slack, right? Face-to-face, eyeball to eyeball, person-to-person, using words. Give me a sense for how the youth of today are getting on.
Well, obviously, my students are excellent.
Of course,
the best.
What do they call you? Mr. Vidler?
Nah, honestly, most of them just call me Lachlan.
Do they?
Yeah.
Lockie?
Yeah.
Yeah.
It's a pretty informal.
Pretty relaxed.
Yeah. I mean, I don't think there's any need to, bring a bit of, formality into a relaxed classroom. So
Do you have a tweed jacket with leather arm patches and some corduroy pants? I hope you dress the part.
I don't.
Yeah.
It's also not my birthday for a while, so maybe that's an idea. Maybe Momentum could gift me a tweed jacket.
I could do that. Get you a pipe.
Yeah. I don't think I'd be allowed to smoke it in the classrooms anymore.
Probably won't be. But so that's pretty cool. So steps you out, sort of. And for those of you who don't know, Lachlan, Atlas Property Group, one of the emerging buyers agents in Australia. Lachlan, he wrote a book, and we spoke about it once upon a time, called The Military Guide to Property Investing.
Yeah, good memory. Right?
Yep, Military Guide to Property Investing, where he lends his experience serving as an officer in the Navy and using some of those sort of doctrinal development and tactical stuff that they do there, and applying that in the sense of some structure and order to property investment. No, it's good. I'm sure you're enjoying the academic life.
It's just a good change up. Honestly, it's a really good change up. Something I'm quite passionate about. I remember, when I went through university, I think for anyone who's either, maybe been through university or just school in general, it can be really hard to learn when you can't identify with the people teaching you. And obviously I'm probably a little bit younger than a lot of the people doing the teaching out there. So yeah, for me, it was just, bring my experience. I've obviously had some different ones to a lot of other people, and bring that in, just be able to have a genuine chat with people that, are learning and want to expand their minds, and I thought I could help them do that.
Yeah, that's cool. Well done. Maybe you'll find the next generation of buyers agents in there as well, right? I don't know. Who goes to university now saying, when I grow up, I want to be a buyer's agent?
All my students say that.
Do they?
Yeah.
All right, it's not a bad gig. You seem to be doing well. But this I quite like it. And Lachlan, I think it's got some of his bearing as maybe his professional experience in his time in the Navy, and also as an academic. He's very ordered in his thoughts, and he's put a couple of points together for me, which, not unlike his book, as well structured, is going to help us steer it. But I've stolen the idea how to be certain in an uncertain market. But you can use that if you want to do that. If you want,
might have to take it.
Yeah.
Who has the copyright? Is it you or me?
I don't know. But how uncertain is it? Like, are you worried about where we are right now? Because a lot of people are a bit jittery because there's so much noise out there. No one knows what's going on. And you saw that brief intro, what's happening globally, what's happening here in Australia, what's happening with interest rates, what's happening with inflation. Can I put fuel in my car? How expensive is it going to be? Can I put food on the table? The trolley of groceries is twice as much of what it was a year ago, they'll tell you. How uncertain is it?
Do you want my honest answer?
Yep.
I honestly don't think it's that uncertain. I think that there's two things. First one is interest rates are going to rise. I think that is beyond certain. Second thing is the interest rate rises are not that bad. We have just come out of a period where it's been the lowest cash rate and the lowest interest rates in the history of Australia. And, I'm not afraid to say it. People have a short memory. And I'm sure there's a lot of people out there who have probably forgotten that that's not actually the norm. And if we move back to, I don't know, a cash rate of 2 to 3%, which from where we are right now is a significant jump. But if we move back to that, that's a pretty normal, sustainable cash rate. And that probably puts interest rates around a 5% mark, maybe fours if you've got a really good lender. That's pretty normal, right? We can't live in a world where we've got interest rates in the 1%. It doesn't function that way. And all it means, and it's what people have seen around the world, or maybe around the world is a bit of an exaggeration, but certainly around the country, have wages really grown over the last 5, maybe even 10 years? Not really. We've been in a low inflation environment for a really long time, and people might go, oh, that's great. Well, money was cheap, but there's been impacts in other areas of people's lives. And when we move back to, we'll call it more normality, it's not that bad. It's not going to be that bad. Banks have tested everybody. Yeah, maybe some people have to give up one night at Uber Eats. Maybe, that $20. I think I did some numbers. I did a showcase, I think it was last week actually, and we worked out that the rise in the cash rate on a $500,000 mortgage was like $20 a week, So it's not actually that bad. It's just the sentiment. And that's something I'd say to everybody is, on a purely numbers basis, what's happened and what's probably going to come, and it's going to be slow. It's not like the Reserve Bank's going to go, all right, guys, here's 1% tomorrow or in a couple of weeks. It's going to be a slow move because they need to test it. They don't want to go too far. But with what's just happened, $20 a week. It's not that bad. It's the sentiment that is often the biggest problem, and it gets people into a spiral, And I'll just say to everybody, take a breath. It's okay. No, the world is not going to end, and it's going to be fine. And and it's what we're going to talk about today, you just have to understand what's going to happen, and you just have to, build your buffers. You need to buy the right properties. You need to do the right things. If you do that, you probably won't even notice a difference.
What Lachlan's talking about there is putting things into perspective, and the headline is, rates going up isn't, if you want to be Chicken Little, that the sky's falling in, right? For the third of Australians that do have mortgages, I was sort of spoken about these stats before, a third have mortgages, the third of people don't have a mortgage, but they own a property, i.e. no debt on, and the other third typically rent properties. So that's the Australian real estate microcosm in a nutshell. But to your point, so for every 0.25 increase in mortgages, what's that, like $2,500 per $1 million of debt?
Yeah, it's not. Yeah, it's not big. It's not big. Like I know it's.
But when you get that, there's another one. For each 0.25 is $2,500. So for every $1 million it happens against two, that's $5,000. Happens against $7,500.
Yeah.
So if you get 4.25 rises on $1 million for the debt, that's $10,000 annually. That's $833.33 a month. You're gonna have to find.
That's some quick maths just there.
Yeah, is that about right?
Can somebody email in if that's correct?
I don't know. By the way, I'm not good at math, but yeah, maths is probably thereabouts.
Yeah.
But so if you get a full percentage point increase on your home loan, if let's just say they pass on all the rates, you're up for about on every $1 million of debt. You're up for about another $10,000. So for someone like you with probably $10 million of the debt, you're going to have to find yourself another $100,000. But working in lockstep with that, and this goes back to Lachlan's point in perspective, is that interest rate rises don't happen in isolation. They're interconnected with the cause and effect of that. So why are rates going up? Typically inflationary pressures. If there's inflationary pressures, guess what? The cost of stuff is going up. And that also includes, if you're a property investor, your rents. So these things largely, it's not going to be a full offset, but you're going to be able to wear some of the increases of the borrowing costs by being smart about reviewing your rents. And no doubt we'll get into that today because it's something that you can do pretty much immediately. So this is understanding, get used to it. It's going to happen. Be comfortable with that. Embrace it even, and start working out what are you going to do about it, which we'll touch on in a moment. Now, this sort of uncertainty around all these factors, a lot of it's also, we've had these a couple of times in 1 month, actually, once in 100-year weather events, which a lot of people have jumped on and said this is climate change in action and things are going to get even worse, and this is a big issue moving forward. And when you mix the natural stuff with the economic stuff, again, it can exacerbate. Are you finding at your sort of client base, people you're chatting to, have people, because I know when the first rate rise happened at the start of this month, pretty much for the next 2 weeks, real estate effectively stopped, right? It's sort of kicking back into gear. But did it take people a couple of weeks to work out, okay, there's a bit of shock there, and this is this cycle that people go through. There's a shock of it happening, and then they just work out organically or however they choose to do it, that it's all okay and get on with that. How this sort of mixed mash of it all, is it going to impact property values moving forward?
I think that like anything, people are really susceptible to things that they hear or that they see, right? It's human nature. Somebody tells you something, particularly if it's somebody that you trust, a family member, a friend, whatever it is, you're just inclined to believe them. And it might take you, exactly like you said, a week or two to maybe realize that that's not what's going on. So there is a bit of that sort of toing and froing. And it's been it really has been a bit of a volatile period for Australia over the last, let's just call it 6 months, right? Or maybe 8 months. We've had some of these environmental things with flooding and thankfully we haven't had the bushfires, because if we had that in tandem, again, that would have just been terrible. But we've had, I don't know if there's been a week, maybe Bomb can come in and let us know. I don't know if there's been a week since the year started here in Sydney that it hasn't been rain on at least one day. It's just been crazy, right? And we've got those things going on. There's been economic concerns, there's been political concerns, there's been all these things going on. But I think more than anything, when people just have a moment to take a breath, reflect on whatever's going on, they quickly come back and realize everything is okay, right? We've got things, we can put protections and mechanisms in place. And I guess that's what we do for our clients, right? We talk about some of these concerns and put mechanisms in place for protection. And you can do that. And for 99.9% of people, you'll be absolutely okay.
And that's going to the point of prevention is better than a cure, which is a good way to look at it. And let's get into that, the prevention side of things. We'll just go to a break beforehand. Stay with us, everyone. Back in a moment.
Ever wondered how you can invest like the top 1% of Australian property investors? Henderson Advocacy has been at the forefront of helping everyday Aussies improve their financial freedom. So if you're a savvy investor or someone just starting out on their property journey, give Henderson Advocacy a call today. Head to www.henderson.com.au. Don't invest alone. Invest smarter.
Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show with Lachlan Vidler. He's director, heads up Atlas Property Group. Now, prevention is better than cure. It makes a lot of sense. I think everyone would agree with that. So how do you make sure you don't need to fix stuff? By being proactive. And the best property investors, smart property investors, the thousands that I've spoken to over the years are largely proactive. I'd like to think I'll probably fall into that bracket myself. So one of the key things to prevent issues in your portfolio, and I would say issues, let's just frame that, issues in your portfolio is I got to sell it when I don't want to sell it because I can't afford it. I reckon that's probably one of the biggest issues, right? Like how do you mitigate those type of things or issues like that? It's about understanding what you want to do in property investment and then going about building it out. And you want a portfolio which is largely scalable, right? Self-sufficiency is a great way to view it. How do you go about building a scalable portfolio so it pretty much does everything you need to do without having to intervene too much on it?
Well, I think, as you just said, the first really big key thing is you want to be self-sufficient. And now what I'm talking about, or what we're really going to be talking about for the rest of the show, is the way that I see is building out that scalable portfolio. Well, firstly, what it is, but then how to do it and what that looks like today. Because I think that, like most things, times change and the way that you go about things also changes, right? If you go back, say, 20 years ago, bank lending was an unlimited tap, right? If you had equity, you could just keep borrowing. I mean, there's books out there, there's probably podcasts out there, there's all kinds of stories about particularly that notion of, say, for example, living on equity, right? If it's there, you can just keep borrowing, and that's great, right? And that, I guess, really gave rise to, say, blue chip portfolios and what you can do there. Times have changed since then and lending's really difficult. And for people who are starting now or have started, over the last probably 5 or 6 or 7 or 8 years, seriously, it's hard to build out those big portfolios. So for me, the first thing that a scalable portfolio is or has is that self-sufficiency. And for me, realistically, that comes down to the idea that it can pretty much cover itself. And there's a few reasons why I think that's important. First one is, who wants to dig into their pocket each month, all right? We all want to go out and have a nice dinner. We all want to buy the kids something nice. We all want to have holidays. And if you're constantly digging into your pocket each week or each month, that detracts from that. So that's the first thing. The second reason why I think self-sufficiency is so important is because it becomes almost set and forget, all right? Now, I'm not an advocate of close your eyes, pray and hope, and then leave it alone. But when things are self-sufficient, it means that if you've got a busy period at work, if you've got family issues, if you've got anything going on in your life, but you know that your portfolio is self-sufficient, you feel that little bit better. It's that weight. It's that thing that other people, it might be stopping them sleep at night. But for us, it means that we don't have to worry about it, right? We can just focus on other things that are going on in our life, good or bad. And I guess the final thing is there's no ceiling on a scalable portfolio. The big things that I see, particularly with those really heavily negatively geared portfolios, and I mean, if you're an extremely high income earner, that's fine, okay? Your situation is going to be really different. But for the everyday person out there, a teacher, a tradie, anybody who works a really normal job, standard job, and earns a really, really standard wage or a family wage, if you take that negatively geared approach and you really build out that blue chip, you're going to get capped. But when you're building out a scalable portfolio, there is realistically no ceiling, right? We will hit limits eventually, but it's a lot easier to keep building and keep building and keep building. And if your goal is to build a 20 property portfolio or a 10 property portfolio, it is a lot more achievable to do that. So scalable portfolios is so important, and it's what we're going to need to do with this uncertainty to really see success in the future. And
irrespective of the uncertainty we're seeing in the market, you should be doing that anyway.
Agreed.
Because when uncertainty comes into the future, and uncertainty might be something you can't control, and uncertainty might be something manufactured by yourself, i.e. a divorce or something or other, right? Like you still want your portfolio to be scalable. And there's two sides of a scalable portfolio, and I agree with Lachlan on this. There's pretty much the asset selection, as in buying the right stuff for today and for tomorrow. But then also it's the cash component of it, i.e. you want it to not be costing you too much money, because if things become uncertainty and times become tough, it should be able to hold its own irrespective of your own circumstances. Now, that might mean you can't do stuff. You can't buy new stuff for a little while, but if the thing can inherently protect itself, that means you can ride out most uncertainty moving forward. Something's got to be pretty dire for a bank to call in the debt that you have on it, right? If you're paying your mortgage and the thing's bubbling along and there's no issues, typically you'll be left alone. So that is a key for most people, but it goes to the point most Australian property investors own between 1 and 2 properties, right? The bulk of, I can't remember, it's 80% maybe of people, I can't remember the number. And the reason why, because they haven't bought their first property, didn't help them build a scalable portfolio.
Absolutely, yeah. I've even come in prepared. Did
I get that number right?
Close. Okay. So 90% of people have 2 or less. So 90% of people have 1 or 2, all right?
So 90%?
Yeah. So, and that's off the last stats. So, I mean, I think...
Is that OBS?
Yeah,
numbers?
ATO. It was ATO. So that, in fairness to the stats, since I do now, do a bit of that with the university stuff, to be fair, that's only in people's names. It doesn't include companies or anything like that. So, the numbers will change a little bit, but there's still a pretty good reflection. And it breaks down to roughly 71% have 1, 19% have 2, so adding up to that 90.
So how many have 6 or more now?
Oh, it's so minuscule. Yeah. I didn't even think it was worthwhile having that conversation.
Yeah, because I remember that because you got 6 or more properties, don't you?
Not quite.
You're definitely
almost there.
Yeah, you're younger than me, right? But I remember hearing a number once, and I go, well, that's about how many people turn up to a Parramatta football game, right? Yeah. Like you could fill a very, very small stadium of the people in Australia who own 6 or more properties. I think it's 20-something thousand by memory.
Absolutely.
It's 20-something thousand out of 25, 26 million people. As a percentage, it's tiny. But I would say it depends. It's horses for courses, right? What constitute a scalable portfolio? Well, you're saying if there's no ceiling, it's largely a moot point.
Yeah.
Whether it's a scalable portfolio for one person might be 3, a scalable portfolio for another person might be 100. And there's people out there with 100 properties.
Absolutely.
But it's an art form to actually do that and get it right. It's tough. It's tough to do it. And if you want to embark as a property investor, the key thing as a property investor is getting the first one, and then typically it's probably going from 2 to 3, right? And those numbers pretty much tell us that's the story. How do you go from 2 properties to 3 properties? Once you get that right, you can typically move on beyond it. But there's a lot of reasons why people don't, and these are the mistakes they make when trying to build a scalable portfolio. And I guess the mantra here is you need to understand and determine what a scalable portfolio are. But where do most people get it wrong?
I think that in the first instance, I think that people don't, generally speaking, match up their own circumstances to what's going on. They jump on a forum, they jump on a podcast, they talk to a mate, and they assume that what's worked for somebody that they know or somebody that they've read about is going to work for themselves. And that's, I guess, just a general overarching comment is that everyone's unique, okay? And that's important. You need to understand that what you do, despite the fact that, maybe your best friend you think is almost the exact same as you with everything you do, maybe you work the same job, you got the same income, all this type of stuff, it's still different, right? There's still differences. So I think that'll be my first overarching comment. But getting down a bit deeper, I think that the first thing that I see these days is people taking that negative gearing approach. As we were talking about before, in previous years, right, and not even probably in recent times, but in not that far of a time ago, it was an approach that was really great, right? Because you build up that equity and you could then maybe look to harness that and do other things with it. But these days, if you don't have cash flow, you could have a $10 million property with no debt, but if you don't have the income to service it, unless you sell that property, you can't realize the benefits of it. So while I'm definitely not advocating you just follow and hunt cash flow, you've got to find that middle point. And with negatively geared properties, you pretty much can't do that, right? And there's obviously a scale. You could have a negatively geared property by a couple of bucks a week, or you could have something by thousands of dollars a week. But for every dollar that you're taking out from negative gearing, it's further impacting past just whatever loan you've taken out. It's further impacting your borrowing. So it makes it really hard to scale. And what I find from the clients that I see is that if you take that approach, generally speaking, you'll cap yourself after 1, maybe 2 properties. And it could take you 10 years plus to be in a position to be able to keep going. So for me, that's the first one, is that negative gearing.
Just quickly, let's just define negative gearing really quickly, because a lot of people go, oh, negative gearing is one of the great property strategies there is, right? And I'll be clear, negative gearing is not a strategy. It's It's an outcome.
Yes.
It's an outcome from investing.
I think I know who told you that as well.
Yeah, it's who's that?
Accountant?
No. But it's not a strategy, right? You don't go, I'm going to invest in property to negatively gear it so I can get more deductions on my
people do it,
income.
though. That's what's crazy.
I know.
It's crazy.
It's absolutely bonkers. And if you want to do that and think it's a strategy, well, guess what? You're probably going to be one of those 90% of people who only have one or two properties. Like, that is the outcome of that particular strategy. That's the outcome of that particular approach. Now, every property over time should become positively geared. It's
Absolutely.
just how long that takes, what you've bought, how much debt you've got against it. It's just really, if you've got a property for me that might be negatively geared, might not be negatively geared for you. It just depends how you've got everything structured. Now, your view of negative gearing, so this is how much essentially it costs you each month to hold the property. Do you consider something's negatively geared by taking into consideration any principal repayments you make against that loan? Where do you sit on that?
So I try and take a more pure play finance approach. And to me, the pure play approach is that principal is a choice. It's not a cost of debt.
Yep.
So when you're doing that, when you're making a principal repayment, because it's not an actual cost of debt, it's not factored into it. Of course, you need to understand what the picture looks like. And I guess this is possibly the traditional finance approach that I take to it, is that based solely on those numbers, you don't take it into account.
So the principal is something you choose to put in there?
Exactly.
So, yeah. Because I think of it depends, the smart property investment portfolio, which I chat about, that is not positively geared taking into consideration the principal components that we place. But across the, 7 or 18 loans in that portfolio, pretty much all of them are P&I.
Yeah.
So when I take out all the principal components, it washes its face.
Absolutely.
So you would say that it's neutrally geared or positively or close to positively geared. Depends how you want to slice and dice it, right?
Absolutely. And I think it's important for people to remember, if you're making a principal repayment, you're actually building your own equity. It's no different realistically from putting money in your savings account. Yeah. And that's why
putting a bigger deposit in the front end of it.
Exactly right. Yeah. And that's why I referred to cost of debt, is because it's not actually a cost of debt, right? You're not being forced to pay that. You're not paying it to somebody else. You're paying it to yourself. So while it's great, you have to understand that if you do that, you might have, and it's a lot of properties that I see at the moment as well, if you take it on an interest-only basis, you might be, say, $6,000 a year positive, right? Or $5,000 a year positive. If you take it on P&I, exact same interest rate, you might be $2,000 in the red, right? And you just need to understand that, firstly, you're going to have to find that money. So it's not like it doesn't exist. You've got to find it. But from a finance perspective, you'd still call yourself positively geared and then positive cash flow out of it.
Yeah, positive gear, positive cash flow. And I guess the holy grail, but again, it depends where you are on your cycle. If you sit there, if you're towards the back end of your property investing and you've got a mature portfolio, if it's positively geared considering the principal components, I'd say you're probably doing pretty well there, because you're driving down the debt and you're also helping to pay down the driving down of that debt through a positive cash injection into it. So it works pretty well. So what do you reckon about buying in areas of high supply? And you see a lot of people get this wrong, and you've had, in many ways, at least Sydney and Melbourne, over this most recent aggressive price growth, a bit of a two-speed market. Houses have grown a lot faster than units, and you find that a lot of the unit markets, particularly those new large high-rise apartment blocks, have really been hammered. Your views as a mistake to buying in high supply markets? Don't do it?
Absolutely. I think, let's not turn it into a university lecture here, but like anything, price is based on supply and demand. And if you've got extremely high supply and you don't have a matching level of demand, or realistically a greater demand than that supply, why would your prices move? It doesn't make sense. All right. It's, for me, that's the biggest thing I see. And I see clients coming to me, or prospective clients who then become clients, all the time. And that's the story, right? They've had a friend, they've had an accountant, they've had a mortgage broker, they've had a family member who has flogged them a house and land package or an off the plan apartment or something like that. And I'm not saying that they're all bad, but just general conversation.
You're probably one of the 90%.
Exactly right. You're probably one of the 90%, and you don't get the growth, and they flog the depreciation benefits and things like that. But at the end of the day,
you too can afford this property because it's got a depreciation.
And I'm sure that everyone's heard it to death, or at least I say it to death. But when you go into those areas of high supply, you're not setting yourself up for success. You are setting yourself up to be in that 90% that don't realistically succeed and have a portfolio that might support retirement or support greater than that, or whatever it is. And it's why portfolios won't scale, or it's why yours won't scale if you take that approach. And I'm very happy to say that as a blanket statement. If you buy in areas of high supply, you will not be able to scale a portfolio unless you've got a lot of money that you can just keep throwing out, because you're not going to get the equity out of the properties.
You're not going to get there. And that, again, that comes to asset selection, right? So asset selection is a product of your cash position.
Absolutely.
And it's, which is a product of where you are in your property investing journey. And, if you just started investing and you've got, a fair bit of cash that you can throw into stuff, well, that might change the sort of stuff that you buy. But if you sort of aim within the centre of the bell curve, i.e. most Australians, so not the outliers on the left would be those who probably shouldn't be investing in property, who are absolutely redlining and being a bit risky. To the right of that bell curve would be those who just money's not really an issue and they can afford to do whatever they want to do. You've got to get that asset selection right inside the middle of that bell curve.
100%. I think, asset, like you said, everybody is different. I'm going to speak again broadly. I'm taking a house over a unit or an apartment any day of the week.
Yeah.
Any day of the week. And for a lot of people, it then becomes a little bit, more nuanced than that. You I guess getting down to that supply discussion and things like that, which, I guess is a little bit outside the asset selection conversation. But if you pick the wrong assets to start with, it makes it challenging. And a classic one is apartments, right? You might buy an apartment, it might be cheaper, but what you got to understand is you might be paying, and costs are creeping up. Hint, look, remember what we were talking about at the start of the podcast. Costs are going up, i.e. strata costs, for example. So if you buy an apartment, you might be spending $1,000 a quarter, and I'd say in a lot of places, that's a conservative number too. That's an extra $4,000 a year that either you got to pay or your tenants have to pay. And that you can't just raise your rents indefinitely. So at some point, you're going to be the one copying that.
And put that into perspective, we're just chatting about that's $4,000 a year. If rents went up, we said a full percent on $1 million worth of debt, that'd be $10,000 a year. But imagine that if it was on the wrong asset.
Absolutely.
Yeah, you're getting hammered on strata stuff as well. And, and again, this is where people go wrong. And they think, they look at the purchase price and go, that's affordable. But then the cost to hold is crippling. And that's particularly an issue to a point that if you don't have a buffer in place, that's when you're the person that needs to sell your property. And that typically means that you can't build a scalable portfolio.
Yeah. Look, I think that the best time to invest is always yesterday, right? And the second best time is today. And I'm definitely not an advocate for extending yourself beyond your means, because that goes against exactly what you said, which is the buffers. But it's an important discussion to have, to realize that you've got to find the middle ground, right? If you have $10,000 sitting off as a buffer for, a standard house, right? I call it a $500,000 house. It's probably money that's not being used effectively. But equally, if you've only got $500 sitting there and the hot water heater goes, odds are on you're going to be having to use your credit card to do that. So it's about finding that balance, but you need buffers there. And I think that especially right now in this, what we've called uncertainty, that I don't think is that
how
uncertain.
To be certain in an uncertain market.
Yep, exactly right.
Yeah.
It's important now more than ever, because people can, for example, price in some interest rate rises. People can price in some extra cost of goods, right? Your repairs that maybe allocated $500 a year normally, maybe now need to allocate $750. And I know that's a pretty big increase on a percentage basis, but if you think about a lot of tradies out there, call out fees.
Well, their prices have gone up 50%.
Yeah, exactly right. Yeah. So it's just about being conscious of what's going on around you, just to have that safety net. Doesn't need to be too far, but needs to be something.
Conservatism always trumps optimism when it comes to financial diligence. So always do your numbers on worst case scenario and hope for the best, right? It's pretty simple stuff. Now, you're finding the right property is the key, and no doubt that's where you sort of sit the intersection between translating people's dreams and hopes and aspirations into finding properties for them. And let's get in that. We'll just go to another really quick break, everyone. Just back in a moment with Lachlan Vidler from Atlas Property Group.
It's time to get help. Interest rates are increasing. Inflation has hit an extraordinary 5.1%, and the chance to secure a golden egg property is getting narrower by the day. Dragan from Buyers Agency Australia has been presenting the facts and helping property investors make smarter, well-informed, educated decisions in property for years. So what are you waiting for? Get in touch with Dragan today at www.buyersagencyaustralia.com.au. Invest with integrity.
Welcome back, everyone. Phil Tarrant, host of Smart Property Investment Show with Lachlan Vidler, chatting through I call it how to be certain in an uncertain market, but I think this mainly originates or is focused towards how to build a scalable portfolio in an uncertain market. And by the way, all of these things is how to build a scalable portfolio flat, whether it's an uncertain market or even a certain market. I think all these same things apply. Now, Lachlan, you've got, I don't know whether you want to call it specific IP around it. You've got your own particular brand of doing something, your acquisition method, which sort of is connecting with your philosophy as a business leader and helping Australian properties. What would be like those 2 or 3 key pillars of getting the acquisition right? Yeah.
Look, I'm going to be honest. I don't think I'm setting the world on fire with this either, right? Like I'm definitely not sitting here saying I've created the secret sauce to discover it. I guess it's about the implementation more than anything else around what we sort of see as our acquisition method and what we focus on. And I'm sure most people would probably go, oh, you know what? I'd probably think of them as well. Maybe I haven't written it down on paper, but I think of them as well. But to me, it's all about that implementation, and that's what sets people apart, and I guess what sets us apart and our clients apart. So for us, the first thing is we want to try and find properties that are undervalued, right? And I know, again, it sounds like a no-brainer, but it's that implementation side of it. When we can go out finding properties for clients and we can find ways to build in 15, 20, 25K equity into them, or in some of the markets that we've just seen over the heated market that's gone on around the country, paying fair value as well, where other people are paying 20, 30, so you can look at that as a negative on them. But for us, we're keeping it down the middle. It sets up your portfolio for success, right? If you know that you've already got 20, 30K there, that could be half a deposit for your next property, let alone add 12 months of growth, or maybe even 6 months in a lot of the markets that we buy in, add a sprinkle of your own savings, and suddenly you might be buying another property in a couple of months only. So for us, that's the first thing, right? You've got to find those undervalued properties. The next thing is that cash flow. And I think that really links back to that discussion that we were having before around how negatively geared properties don't support you in building a scalable portfolio. For us, ideally, we'd love cash flow positive. But in the worst instance, we're not against a cash flow neutral or neutrally geared property either. At that point, income matches expenses, so that's okay. It's a reasonable point to be in. The banks won't look at you in too much of an unfavorable manner because you're digging into your pocket each month. You're also not digging into your pocket, so maybe your significant other or your property investor colleague isn't also tapping you on the shoulder saying what's going on. So it sets you up quite well in that regard. And more importantly, it means that if you're starting from that point and rents grow for the next year, 2 years, 3 years, 4 years, whatever, very quickly you're accumulating quite a significant passive income. Multiply that across a few properties. And, that's people's wages being replaced. That's people's holiday funds being bolstered. It's kids, maybe your kids' property fund being increased. So that cash flow side, really important. We don't want to go too far though, because then you probably won't get growth. So you need to find that nice balance point, sweet spot, almost like when you turn on a manual car and you've got to balance that clutch out,
Well, mate, I grew up in Blacktown. I love to do a burnout. I grew up doing burnouts, and I'm sure there's some sort of property metaphor in that. But you make a good point. It's not necessarily the what, it's the how. And the what in property investment is like, I haven't heard that many new ideas which are completely transformative, right? Like, I think largely most people know, and property is simple. And if anyone makes property difficult to understand, where they'll tell you about, don't do it the old-fashioned way, do it by buying options and all this sort of stuff, right? Like, you can make some dollars out of that, but it's not your traditional method, and a lot of people don't always get it right. But to do property good, just look back through time, and people have bought assets well, and they've been able to hold on to the property. So at a point in time, they realise the benefit of it. And that's very much what you're talking about here, the what. What is it you're doing? It's finding good properties that are cash flow neutral or positive, and they have the potential for upsides. That's pretty simple. It's how you do that is the secret. And the how is hard.
Absolutely.
The how is hard, particularly when there's a whole bunch of other people trying to do the how, who you're competing with, right? This is not an isolation. So like you find it and no one knows about. Well, I guess that's what an off-market property is, right? Being able to control it before someone else gets in there. So that's a how, and that's the hard bit. And if you're doing this by yourself, that's cool, but you're doing it up against, in a competitive mindset, people that do it for a living, people like Lachlan. So if you want to play the game, well, you've got some hard competitors.
Absolutely. I mean, our office is also here in Sydney, just up the road, and I was almost late for our recording because we were trying to put a deal together, and I was looking at our system and where we map out where all of our properties are at, ones we're buying, ones we're negotiating on, ones we've missed out on, ones that we just haven't gone ahead because they were unqualified. And our unqualified bucket was 10 times the size of our qualified and bought bucket. And, it's really hard for people out there who are trying to do it themselves in markets like this when you're up against people who are doing it professionally. Because I've got 3 people who sit there day in, day out, getting the off markets, getting the pre-markets, going through the on markets as well, and qualifying all of them. We've got a number of people doing that, let alone if you're trying to do it yourself. And it's that implementation side, which is what they're there to do and support, our clients to get results that, if you're going off to your day job and you get home, you got to cook dinner, you want to see the family, it's just hard to do it.
Yeah. And I hear all the time people think they can do it themselves and they get so fatigued looking at realestate.com and going, I look at all these places and there's always $100,000 more and it's all rigged and the system's flawed and it's, it's a competitive environment. And I'll tell you what, the most recent market has been a tough one for most people to operate within because of the spiking costs and the competitiveness of it. But in many ways, the balance of power is moving back in the hands of the professional buyer's agent. There is still, stock on market. There's not a lot of it out there, and trying to understand, particularly negotiating with vendors who their property might have been worth $100,000 more 2 months ago. That's not the case anymore. So you really need smart real estate agents who can sit there in the centre to negotiate with the buyer's agent and get it done. But that's the market we're moving in. Let's be clear, also, Lachlan, that all of us typically have some not so good property in our portfolio, and I think it's just the maturity of identifying when that's the case and calling it. But the 90%, we talk about the 90%, often they've bought the wrong assets. So they've got probably the wrong assets in their portfolio. That doesn't mean you're stuck with them forever. You can fix these things. So, how do you go about fixing a portfolio if you know you've made a mistake? And I hear it all the time. Someone will go, I need to speak to a buyer's agent. Buyer's agent goes, yeah, there's the wrong properties, And a lot of people don't like the idea because everyone in Australia thinks they're a real estate guru, right?
Yeah. Well, everyone is a guru, Everyone's got their story. But, look, first thing I say to everybody, right, and I think it's the most important thing is take a breath and let's look at where you want to be and then compare that to where you are, all right? There's no point thinking that you've got an underperforming property or an underperforming portfolio if you haven't actually stopped to smell the roses and check that, okay? It's so important to actually look at it because you don't want to have to go and sell a property if you don't have to.
Yeah.
So that's the first thing. Look at where you want to be, look at where you are and compare them, all right? Once you've done that, then you now need to look at your opportunity cost. So if you go, all right, well, we bought this property, 5 years ago, we haven't had the results that we want out of it, add it all up, work out, all the costs that you put into it. Don't forget how much you've spent on interest. I see a lot of people go, I only spent this, some stamp duty, this. If I sell it now, it's all good. People forget to include the loan cost. Fortunately, it hasn't been much over the last couple of years. That's in your favor, but make sure you add it all up and then look at what it would cost to maybe divest that asset and look to purchase something better because you want to make sure that it stacks up. And it's okay if it doesn't, right? It is okay to have an underperforming asset and make the realization it's not the right time to get rid of it yet, okay? It's about understanding that opportunity cost because if a professional helps and looks at it and goes, look, I think, reasonably speaking, if you hang on to this for maybe another year or two, you're probably going to get into a significantly better spot than you're at today, and then we can look to get rid of it, Or it's still a pretty good market in a lot of places. Maybe now's the time to capitalize, right? Yeah. If it's an underperforming asset for you, it might be another underperforming asset for somebody else. So it's important to remember that to go, okay, maybe my pool of buyers won't be so big. Maybe we look to get rid of it now. It's all individual. So you got to keep that in mind. Review it all right? Make your plan, work out what you're going to do, run the numbers, decide, or not yet, don't decide yet, but work it all out so that you've got it on paper and you can make a really good argument for what you're about to do. And then walk away from it and come back the next day. You need a fresh set of eyes, particularly over these big life decisions, but then take decisive action, all right? Don't sit back, don't ponder it. Everyone has a story about how they wanted to buy a property 12 months ago. Clients that come through the door might have even engaged with us 12 or 18 months ago and they go, oh my God, we just did it. I signed a client on last week who said, we came to you 3 months ago, we didn't do it, we've just wasted time. We've been trying to buy a property for 12 months before that. So we've now wasted the better part of 18 months, right?
Which probably translate that into probably 25% growth on their money.
Absolutely. Opportunity cost.
Yeah.
And
that there is opportunity cost, missed opportunity cost, as in that procrastination to potentially pay you, I don't know what your fee is. Probably, I don't want to pay him that. We'll do it ourselves. If it was a $500,000 property, they've walked away from over $100,000.
Absolutely.
Put that in the context.
Absolutely. It's significant money. And I said to these people, don't think about your opportunity cost. In this case, it's just going to end in tears. So don't think about it in that case. But it's so important to take your decisive action.
And that's the old mantra of imperfect action is better than perfect inaction.
Yep.
So once you've got enough information to take that step, do it. And whether it's buying or whether it's having the maturity to look at a poor performing asset, like work out what it's going to cost you. You might need to walk away from a few bucks. And again, speaking to a lot of property investors, you go, what's the biggest mistake you've made? One of them is I didn't buy enough. I could have gone a lot harder. I could have, and I wish I started earlier. Now, you've got to make mistakes in property. And I tell you what, if you make them earlier on investing in property, guess what? You've got a lot more time to fix those mistakes. It's when people make these mistakes too late in the cycle, when they get to the point of their mid-50s or late 50s going, wow, I'm looking down the eyeball of retirement in 10 years. I've done nothing. I better hurry up and invest in my future. You don't have time on your side. You can't afford to make mistakes. So start early, make your mistakes early, realize you made a mistake and move on. And if you need to wear it now, painful lessons are sometimes the best way to help shape better behaviours into the future. So that's why you got to look at it. Fix a problem before, so it doesn't stifle you for doing more of it. And sometimes you need someone else to have a look at it. You might not know you have some problems in your portfolio until someone else scopes it out. Lachlan, that's pretty good, mate.
Thank you.
Covered a lot.
Yeah, I think it's good.
Covered a lot. Mate, you should do this as Finance 101, Property 101 at University of New South Wales. You're the business school there, right?
Yeah.
That's a pretty fancy school.
Yeah, it's pretty good. I think it's about second or third in the country, and I think it's like, top 30 in the world or something like that. So it's it's a pretty good school.
That's good. When are you going to start doing property as a lecturer? Lecturer of property investing services.
Oh, look, there's property positions out there. It's a loved industry in Australia. Yeah. And it's certainly, compared to other places, we have...
I think we already have a property professor though, don't we?
We do have a property professor, yes.
And you're on the board of Pippa now.
I am, with Peter.
Yeah.
Yep. So...
the property professor.
Yeah, well, I might have to think up my own one.
Yeah. I don't know, what can we call you? I don't know.
We could and ah here for the next 10 minutes and probably not.
No, it's cool, mate. That's cool. Well, thanks for coming in and sharing all that stuff. If you had $500,000 to spend today, where would you spend it as an investment property?
Oh,
1, 2,
probably
3.
either Brizzy or Adelaide.
Oh, okay, that's expected.
Yeah. It's just where.
They're
big locations.
It's not what, it's how, and the how
exactly
is
right.
And the how is what the asset selection and I tend to. Well, South Australia, Adelaide's always been a constant performer.
Yeah.
Whereas Brizzy is going through a bit of a stalled cycle, which it needed to drive forward. Anyway, well, next time you come on, let's maybe break that down a bit, eh?
Maybe we could
give us some intel.
Gosh, I don't. If we leave it for a long time, maybe I don't want to look back at what happened. Maybe I could be entirely wrong. Who knows?
Where's the next market that no one yet knows about?
Oh, I'll have to keep that one under wraps. That's what the clients come
Alice
for.
Springs, Ayers Rock.
Well, you never know, do you? I mean, my money's probably not there, but you never say never.
What about regional markets? Do you reckon they're going to keep firing along? These markets sort of strike conditions for capital cities. This is my thesis, right? Because they still seem to be driving forward. If an hour and a half out of the capital cities, commutable, but you don't have to do it every day. They seem to still be
I'm a massive fan.
Strong.
I'm a massive fan. I think obviously you got to look at it, right? You got to keep it in context. How big is it? What are the industries that support it? Why will it continue to grow? What's in the pipeline? Things like that. But realistically, affordability is a big discussion. And when work from home is, world economy, it's going to stick around. Probably hybrid more than anything.
It's hybrid.
And I think you guys maybe do it here. We do it at Atlas. A lot of places do. Why wouldn't people want to do that, right? You can live in places that you probably never thought you would, be close to family, friends, buy that house that's double the size or buy a house for some people. And realistically, there's a rental crisis going on.
There's a huge rental crisis. And it's only getting worse because we're not building properties.
Exactly.
And so, because of all these things we spoke about. But
I
tend to agree with you on that. And until again, it's supply and demand, right? At the moment, the demand for workers is high and the supply of workers is low. So the power sits with the worker at the moment. So companies are going to start mandating people back into the office. But when that becomes inverse, whether it does become inverse, where unemployment goes up and the employer has a greater choice over who they, that's where you're going to start mandating that. But I think that's years away, to be honest with you.
I think the bosses also are liking the fact that they can, do their meetings.
A hybrid environment.
Yeah, absolutely. Look, I think it's great. Honestly, I think it's one of the best things that's happened. I think that giving people the choice to do it, because there'll be some people who love going to the office. We got one of the girls in the office. She loves going in, right? And I say to her all the time, you could do the day from home. No, I want to be there. You're then going to have the people who probably take it too far the other way and they never appear. Yeah. But I think in the most part, people just go, I love the fact if I got a doctor's appointment, I can hybrid from home, work a bit later. It's easy, right? We can, cutting out hours of commute time. There's a lot more underemployment. There's less underemployment going on because people are,
they've got more flexibility.
Exactly right.
Yeah, I agree.
Honestly, I think it's good. And I'll be surprised to see if that actually fully changes,
I think what will happen eventually is that we'll end up at a 4-day working week is where it'll go.
You reckon?
Yeah.
Well, they're trialling it.
I reckon in time, and that's, But some people already want 4-day working weeks and they go, well, that's fine. I'll pay you for 4 days. No, I still want 5 days work. Anyway, who knows? It'll be they'll come up with a name with it at some point, but like the Industrial Revolution changed the way in which we worked. And by the way, we're just going back to how it was before the Industrial Revolution.
Yeah. It was 6-day weeks.
Used to be cottage industries where you sat in the front room of your house sewing something and then you take it back to the factory and go, I've just completed this. And then you picked up some more stock, went home, went in the front room of your house. So the Industrial Revolution changed that.
Absolutely.
But what's happening now is the knowledge economy is going back to the front bedrooms of people's houses right across Australia.
Well, Saturdays are an expected work day not that long ago.
Yeah.
For everyone. Yeah. And Sunday was the rest day. Mm. And I think I was actually having a conversation with somebody about it. And I think it was honestly... nobody call in or not call in, but email in and quote me on it. But I think it was
smartpropertyinvestment.com. You send your hate mail there.
I think it was honestly like the 50s or the 60s or something where I was reading it was albeit something academic.
Half day on a Saturday.
Yeah, it was something like that. So it's not actually that long ago where the weekend wasn't the weekend that we know now, let alone this 4-day conversation.
Mate, I remember when shops weren't open on a Saturday.
Yeah.
Or Sunday. Whereas the shops don't open on Sunday.
Yeah.
Now it's like one of the top retail time. So things do change. Embrace change. As a smart property investor, embrace change. That's how you can build a scalable portfolio. And irrespective of how uncertain the market is, you can invest with certainty.
Absolutely. Love that.
How good is that? Anyway, Lachlan Vidler, thanks for joining us today, mate.
Thanks for having me,
Back
Phil.
by popular demand.
Love that.
Yeah.
Popular demand. I love that. Yeah.
And keep up the good work you're doing with the Property Investment Professionals Australia as well.
Thank you. Yeah. Pippa's great. Lots of good stuff. I think that there's actually we're doing a meetup in Sydney.
A meetup? That sounds very modern.
Yeah. Well, I think we're going to have some guest speakers.
Okay. I noticed you haven't asked me to come.
Yeah.
I'm not a guest speaker.
I'm not.
Are you a guest speaker?
I am not. I think we're actually having Eliza Owen coming
Eliza.
in. Yep. And I think we might have another guest speaker as well. But I think Eliza's the keynote, if you will.
Eliza is at Domain?
CoreLogic.
CoreLogic.
Okay. Yeah. So
she's on the show a fair bit.
Is she? Yeah. Actually, I've seen that. Yeah. But if you're interested, I mean, it's a peak industry body for property investment professionals, but also consumers. Come along, great guest speaker. I think it's at the end of May or first week of June, and it's a breakfast keynote. It'll be great.
Cool. You heard it here first. We'll make sure we put that up on smartpropertyinvestment.com. There you go and check it out. And there's also Picker still going.
Picker, yes.
Yeah. Property Investment
Council of Australia. Yeah.
So rest assured, there's people in the property investment industry who are helping to advocate and support smarter investment. This is part of the work that Pippa does. I was on the board of it for many, many years. They do some great work. Thanks for joining us, Lachlan. Good one. Remember, smartpropertyinvestment.com.au. One favour for me, and I'm sure every single person in Lachlan's office is going to do this as soon as they listen to this podcast. They're going to leave a review. Typically on iTunes, that's where most people listen to this. It's just not myself here having a chat behind a microphone. It was a great team of producers and AV crew here who make us sound good. They get a real kick out of it. So I'd really appreciate it if you could do that as a favour for me. Just leave those reviews. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
It's safe to say the property market has been red hot over the last few years, with some of the markets we've selected in 2021 rising over 40% in a 12-month period. It's very likely that if you're a property owner, your property has gone up 20% minimum in value in the past 12 months, and you have most likely accrued sizable equity that can be recycled and extracted to build your investment portfolio. With interest rates increasing, you might be wondering where to invest to maximise capital growth and cash flow in 2022 and beyond. Well, to save you time, energy and guesswork, award-winning author and regular guest on the Smart Property Investment podcast, Paul Glossop and his team at Pure Property Investment have outlined the top 30 affordable suburbs poised for strong capital growth over the next few years with sound cash flow. Grab your free Top 30 Guide to Property Investment guide today at purepropertyinvestment.com.